Hey everybody, welcome. Time for managing an options portfolio. My name is Brent Moores, and we do this each week where we talk about an options portfolio and manage various types of trades on that. So we're going to do that as usual on that, and I also want to talk about specifically automating some exits on some trades. We're going to deal with that as well. Before we get too far in this, though, let me just mention a couple things. One, Ben is going to be joining me in the chat, I believe, and I appreciate Ben, and you can always follow him on X. I've been working with Ben for many years. At Ben Watson CS is his X handle. My X handle at Brent Moore CS. I post some additional content throughout the week on X, if you're on X, related to markets. And I'm just glad to see a lot of familiar names there in the chat. And those of you who are new or are watching on a recording, we're glad to have you as well. Now, we're going to be talking about options today. So just remember, options do carry a high level of risk and are not suitable for all investors. And multiple leg option strategies will involve multiple transaction costs. Now, I may not talk about commissions and fees on those on all these trades. We'll do example trades, but just realize commissions and fees are a part of options trading you need to be aware of. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. And let's see, paper money application is provided for educational purposes only. All investing involves risks, including loss of principal. Schwab does not recommend the use of technical analysis as the sole means of investment research, and past performance is no guarantee of future results. Let's see, I think that's it for our disclosures here on that. And let's get to it here. Let's head on over to the Thinkorswim desktop software. This is the SPX. Had a little pullback on this a little bit today, but in the grand scheme of things, don't get too panicky. It seems like that's where we were. We've come a long ways. It's been a strong trend. We're still above that 20-day moving average. Most stocks have been going up, but not all stocks, and we do bullish and bearish trades in this webcast. Now, what we're going to do here today is I want to go through a variety of option trades and talk about managing those. But I noticed we don't have any long verticals in the account right now. So I was going to look to add some long verticals and talk about management of those as we do so. Okay. So then we're going to manage a variety of other types of trades as well. But when we are trading, just what I want you to consider are three scenarios. Doesn't matter the type of option trade, probably doesn't even matter if it's an option trade or a stock trade or other types of trades, but just realize, have in place before you enter the trade when you're going to get out. Okay, don't wait until the moment of decision of the stock dropping or stock doing really well or whatever before you decide when you're going to get out, because then you're incorporating this emotion into the trade, which doesn't help your decision making. So decide ahead of time. But what I want you to think about is what's going to happen if the trade goes well. When are you going to exit that? Okay. Now, there may be trades where you decide you're just going to let it go to expiration, or just kind of indefinitely hold it. You're buying a stock and you're going to just continue to hold it as long as it keeps going up. That'd be a scenario of it going well. But a lot of times, you may exit when we hit a certain profit target. So that's one thing we want to talk about. We also want to talk about what if, and what you need to consider, what if it goes against you? What if things go not according to what you want it to, but it goes against you? So consider that. And then there's a third one, and you're going, well, look, goes well, what else could there be? And there is, what if it just kind of hangs out? It's kind of a so-so trade, maybe it's a bullish trade and the stock goes up just a little bit or something like that. So if it's a so-so trade, I want you to think of that. Okay. All right. So in the case specifically, I want to, and of course, different trades we're going to handle differently. But in this, what I want to focus on today right now is long vertical spreads. Okay. So there can be bullish long vertical spreads. There can be bearish long vertical spreads. Bull, also known as a bull call spread or a long call vertical, or on the other end, a bear call spread, a bear put spread, or a bear put vertical. Those are vertical spreads. And just as a quick side note, the terminology on options can be kind of confusing, right? So when we say a bull call spread and a long call vertical, they're the same things. A vertical spread is just two options, same expiration, same type, calls or puts, and you're selling one, you're buying one. Okay, that's a vertical spread. Once we throw in the name call or put in that title, then it designates what type of option is. Is it calls or is it puts that we're dealing? If we say bull or bear, that's telling us the direction we want the stock to go on that. And if we say long or short, are we buying up front or are we selling it up front there? Okay, so let's talk about long call verticals if it goes well. When are we going to actually look to get out of these trades? Well, one is very often we may just look at the stock price. Okay, we may very well do that. We may just say, hey, you know what? My stock is, I think it may go up and hit a target price. I'm going to put an exit based on the stock price, not the option price. Okay, we can do that. And that's if it goes against us. We can say, oh, if this breaks support or breaks resistance in the case of a bear trade, I want to get out. So we can get out based on the stock price, what the underlying stock is doing. And we can put an rules-based order to do that. We do that quite often in this trade. All right. Now, the so-so, not so much. That's not going to be based on stock price. The stock may be kind of going sideways. But here, we're just going to say we're going to get out. And very often we'll say we're going to get out if there's less than 10 days to go to expiration. Now, we don't always use 10 days. Maybe we say a week to go to expiration. The point is, on these trades, typically we're not holding them all the way within a day or two of expiration. And one reason for that is something we call gamma risk. And that means the trade can move pretty significantly, much quicker as you get very close to expiration. And if things are going okay, they can go from okay to really bad in a short amount of time, especially if we're holding them closer to expiration. Now, technically that can happen anytime, but the risk of that seems to increase as we get closer to expiration. Okay. Now, but there's another thing I'd say, and that is sometimes we can do it based on the option price. So we can do it based on the stock price, or we can automate our exits based on the option price. So for example, on a long call vertical, maybe we say we've made 75% or 80% of what we can potentially make on this trade. And that is absolutely a valid way of doing it. Or maybe if it's going against us, could we say, well, if we've lost 50% of what we can lose on that, we're going to get out. These are based on the option price in the spread price. This is based, so we're using the stock, we got to use that rules-based order. On this, we're just using kind of a plain stop or plain limit price on that. Okay, now in DDP says, hey, can we use a trailing stop on the price of a stock? Well, you'd probably have to put in, that would be a little bit more complicated on that. You'd probably have to kind of script that. If we're putting in a rules-based order here, usually we're just doing a plain stock price. Of course, you can use a trail stop, but your question is very specific to on an option trade, can you use effectively what's a rules-based trail stop on the stock? Probably going to have to script that, probably outside what we're going to do here today. But generally, if we're going to use a trail stop, it'd probably be based on the option price itself, which we've done in the past. And we can even look at that perhaps today a little bit and see what we got on that. Okay, so those are kind of the three scenarios I want you to think of. I don't care, the specifics here are based on vertical spreads, but the general, have an exit going well, if it goes well, or if it goes against you, or if it's just kind of hanging out, going sideways, any option trade, I want you to consider that for, okay? All right, now, let's go back and let's look at some trades. Let's look at a couple example trades there. Okay, there is a survey link in the chat, by the way. So we appreciate your feedback. I read all your comments, and when possible, I try and incorporate, any suggestions or anything you have into the presentation. Now, there are parameters in the class. For example, I teach a long options class. I just can't do short options in that class in here. This is a managing options portfolio. If you say, I want to learn more about futures or something, what I'm going to say is join Ben Watson on Tuesdays for his futures webcast, which he teaches at 9:30 Eastern time. So, but also, just a heads up, if you want comments, use the feedback. You can message me on Twitter or X. You can put comments in the webcast. That's fine. Don't try and email me. I can't respond to emails to you. Okay. All right. Let's move forward. Let's look at an example. And I'm going to do, as I normally do, I'm going to look at a bullish and more a bearish example. I'm going to look at Broadcom here. And what I'm going to do is I'm going to consider this more of a bullish example. What I'm going to say is this. And remember, there's other approaches than just technical analysis on these. But what I'm going to say is we've had a general trend up, and I'm going to consider, my line's a little crooked there, I'm going to consider that to be kind of a, support level. Now, if this breaks down, let's say we go down here, we're probably going to look to exit, right? And we can do a stock-based exit on this. Right now, we're pretty close to support. Stock's at 336. Let's say we go below, let me just get my cursor here. One sec. Let's say we break down here. It's about 330. We could just say we're going to automate our exit on that ahead of time. Now, later in this session, what we're going to do is we're going to look at trades and we're going to go, well, look at this option. Should we get in? Should we get out? I'm talking right now about automating the exit. Exiting if we get out at 330, okay? If the stock goes below 330. My goal is, hey, this is down here. I think it's going to stay up here. I think it's going to go up. I think it's going to be bullish in this example. And I think it may bounce up a little bit. So we're going to put in a spread, and I'm going to put in a vertical spread. So I'm going to go to Trade tab, and I'm going to go here, and I'm going to give it, it may take a little while for it to go up, so I want to give it some time. It may take a few weeks. I don't want to cut it short. So I don't want to pick expirations that are 2 or 3 weeks out in case it takes 2 or 3 weeks. Remember, because I want to get out with about 10 days or so-ish before expiration. Okay, so I'm going to give it a little more time here on this. Furthermore, look, if it goes up here, I'm just going to get out. That's what my goal is. We'll say about 365, we're just going to look to get out at that point. That's going to be our exits here on this. But let's put that trade in. So I'm going to go out. I can go monthly, go out a month. I can go out a little bit further. Let's go out just a little bit further here. Let's go to 37 days. Double check our liquidity. Double check our bid-ask spreads on these. And because sometimes they're a little less liquid on these weekly options, still doesn't seem unreasonable for a stock that's as expensive as that. And I'm just going to go change single to vertical. I'm going to go and I'm going to, now it gives me $5 apart, okay, because that's a strike width. Now, if I want, I can change that and say, well, I don't want it one increment apart. I want more than that. So you can go to spread, deep and wide. It's going to be 1 month. And I could say, I want it 2 strikes wide or 3 strikes wide. And then click on vertical. And then look what happens. It gives me wider spacing on that. But the reality is what I normally do, just because it's easy, normally I say, I'm going to just do, say, 335, 340. I'm going to say, I don't want 340. I want to give it a little more headroom up here. And I'm going to go to 350. Okay. And so there's my trade right there. That's my entry order on this. And if I want to get out, I'm going to do the exit in this example based on the stock price. As we mentioned, you can do it based on the stock price or the options price. How am I going to do this based on the stock price? Well, all I'm going to do is I'm going to make this a first trigger sequential order. I'm going to right click on it. I'm going to create an opposite order. This is going to be my order to get out. And I'm going to make it rules-based order. Market, good till canceled. And I'm going to click on my gear. And I'm going to say, I want to get out if Broadcom marks less than or equal to, and what did we say? We said, I jotted it down, 330. That didn't work. Let me try that again. I mean my number lock on my keyboard. 330, or if it goes greater than or equal to 365. Now, it may not hit either of those. And at some point, we'll look to get out anyway. But I'm going to click on save. There's my order. I'm going to click on confirm and send. Let me actually just, I'm going to go down just a little bit here. And just read it over. Make sure it reads right, makes sense. This is going to go in our vertical bucket. Click on send, and it's thinking. We'll see if that fills, okay? So that's an example using and it just filled. That's an example using exit based on the stock price. What about the option price? Well, let's do it. Let's do a different example. I'm going to do a bearish example in this case. I'm going to look at CMG, and remember, technical analysis isn't the only way to do things, but I'm going to use technical analysis, and we use that in this webcast quite often. My assumption is, let me get rid of that drawing there. My assumption is we've been going down. We've kind of used this 20-day moving average as kind of a resistance level. Looks like we may be getting kind of a resistance bounce going down on this. And, 40 is kind of there, is kind of where we're bouncing off of, or maybe going down a little bit. I'm not looking for a very long trade. When you're entering the trade, consider how long you're planning on being in. And then you want to buy extra time. You want to give it some wiggle room, a little buffer there. But still, you need to have some sense. If I think this trade, if I'm going to be in this trade for a month, I want to buy more than a month of time. If I think I'm going to be in this for just maybe a couple weeks, then I don't need to buy that much time. In this case, I'm looking for kind of just a shorter term move, just a few days perhaps on this CMG trade. So let's do it. And we're going to put an exit based on the option prices here. I'm just going to go out to the monthly contracts. And let me go back to singles. Look here. There's our spreads. Good. Pretty tight spreads. That's good. And stocks at 39.18. And I think it can go down. Is 38 unreasonable for it to go down to? Let's just take a look. 38's down here. No, that seems like a reasonable kind of area where we may target this trade. So I'm going to pick 38 and maybe do like 40. 40 and 38 is a $2 wide spread. Let's just kind of see what that looks like. 40 and 38. Again, I'm going to go to vertical. I can do the whole deep and wide thing and make these wider, but I can also just say, hey, I'm going to just enter this trade, 40 and 38. A lot of little, oops, what did I do? Just see if I can find 38 there. There's 38. 40 and 38, we're showing a 97-cent debit. We want the stock to go down to hopefully 38. That would represent our max gain at expiration. And then at expiration, 40 would represent our max loss. Of course, our gains and our losses change over time, right? If it goes to 38 tomorrow, we're not going to be at a max gain, okay? If it goes to 40 tomorrow, we're probably not going to be at a max loss either because of the time element on the options there. But in this case, let's put in exits based on the option price, not the stock price. So what I'm going to do here is I'm going to just do a first triggers OCO. Okay, it's going to give me, and I'm going to right click on this. I'm going to create an opposite order, and we're going to do that twice actually. So we have two separate orders. One is going to be our target, or the good scenario. One's going to be the bad scenario, okay? So let's do a stop here first. Where's our stop going to be on this? I'm going to make a good till canceled. I'm just going to make all this good till canceled right now. Where's our stop going to be on this? That's maybe a little bit easier. Well, how much can we lose on this? Well, if we're buying a vertical spread for $1, I'm just going to round up 2 cents here. If we're buying it for $1, it could go down to 0 potentially. It can't go lower than that. It can go to 0. So half of that, if we're going to put a 50% stop loss on this, I'm just going to make this 50% stop on that, okay? There we go. So that's my stop to get us out. It's based on the option price. What about a potential gain on this? That's going to be our limit price. Well, this could go up, but it may not be intuitive how high that can go. But let's just kind of look at this trade. Let me click on confirm and send. It's giving me a max profit of basically 102. Now, in this case, it's kind of, the math's pretty easy. It's a $2 wide spread, and we're buying it for $1. The most this can be worth is $2. So the max gain we could have is basically $1. Again, I'm rounding 2 cents here on this. But sometimes it may not be quite as easy, the math there. That's why, rather than kind of working out the math on that, it's just really easy. Just click on this part of it's really easy. I know there's more complicated parts of things, and I'm not saying the whole trading process is easy. I'm just saying clicking on this confirm and send button and looking here at what your max profit, that part's pretty simple here, okay? $100 is our max profit on that. So if I want 75%, what's 75% of 100? Well, 75% of 100 is $75. I'm not going to put in $75 here because we're buying it for $1. So to realize that $75 profit, this would have to be worth $1.75 here on this. In other words, I'm going to add the gain I'm looking to get to the initial purchase price. So if the gain I wanted to get was, say, 50% of the max gain, and the max gain was $1, that would be 50 cents. I would then take my initial price, add 50 cents to that, and get that. In this case, we were looking for a 75% max gain, okay? So this is a limit price there. Okay, now, Scott in the chat said, let's go back to this stop here. Let's go back to this stop here, because there's a question that Scott has, and I think a lot of you probably have here on this. I chose stop, which technically is a stop market price. It's a stop market. It doesn't say market there, but it's a market. It turns to market price. In other words, we hit the activation price of 50 cents or less, it turns into a market. We have another choice there where we could say stop limit. And that is certainly a valid choice. If a stop limit is hit, what it's going to do is it's going to churn into, once the stop price is hit or below, it's going to turn into a limit price. And the limit price is going to restrict how low we're willing to sell it for. You certainly can do that. Keep in mind, with the stop, the price isn't guaranteed. This could sell, instead of 50 cents, it could sell maybe at 40 cents or 30 cents. We don't know what price it's going to sell at. If we put in a limit price, say at, let's say we did 45 cents, once we hit 45 cents or less, it's only going to fill at 45 cents or more, which sounds great, but there's a downside, and the downside is it may never fill. If this gaps down, if this stock goes against us, in this case, against us would be going up because this is a bearish trade, then we may never get out on that. So as Scott, I have no objections to the idea of using a stop limit on these. Just realize the pros and cons of these various types of trades. Stop market orders are not guaranteed to get you out at any particular price. Okay, that's the bummer. Stop limit orders aren't guaranteed to get you out at all because if the limit price isn't there. So as long as you know pros and cons, absolutely you can do that. Okay, let's move forward. So there's the trade setup right there. Make sure they're both good till canceled. We can click on confirm and send. Let me just double check. Right now it's showing 98. That'll probably fill, I would think. Read this through. It's an OCO. So if we hit one, if it goes well and we get out, it will cancel the stop order and vice versa on there. So let me go here and we're going to put this in long verticals and we're going to send that order. Okay. So that's the first part of what I wanted to do in the webcast today, is I wanted to show you exits based on both on price-based, stock price-based exits as well as options exits here. But let's look at some other types of trades, because we just talked about verticals, long verticals. What about short verticals? Well, in the case of short verticals, we're going to have the same kind of things and we can see I have some exits here on this, but they haven't been hit. And we're losing a little money on this, but it can certainly get worse. We got 7 contracts. The trade price, you see the trade price and the mark price. It's not ridiculously far from that. So we're down, but it can certainly get worse. We still have got 23 days to go. If this were a week to go, we'd probably just get out. Boom, just get out. But the question is this. This is a bullish trade. It's a short put vertical. We want the stock to stay above 55. We want it to go up. Right now it's at 58. Are we still bullish on Delta? Let's take a look. If we're still bullish on Delta, or at least kind of neutral or something, then we'll stick with it. What I'd say is this. It's not super bullish, it seems like, but it does seem like this is it's reasonable to consider a support level here. So what I'm going to say is, let's stick with it. Let's let that time decay work on the trade, because remember, this is a positive theta trade. Time decay is helping us out on that. And it's not bearish. If we turn very bearish on this, probably just going to look to get out. But we're going to punt on that one. We're just going to stick with that for just a little bit longer here. Okay, let's look at another one. We got Marvell. Okay, Marvell Technology. We're out of this trade. Okay, so quantity 0, and I think that just means we hit a stop or something like this on this. Well, let's see what we did. So to look at this, how can I see what happened to this trade? Well, I can look at filled orders and see, here it is, Marvell. We got out at 15 cents. When do we get in at? Well, I can't see that on this page right here, but I can see that if I go to account statement, type in MRVL, and look and see. So here was the initial trade. We got in 53-cent price. We sold it for 53. We got out at basically an 80% gain. So that just automatically triggered. That's an example of what we were trying to illustrate earlier. You can automate your exits, which we did on Marvell, and it filled. Or you can decide not to automate the exits and, kind of look at them. And sometimes we do that. But in this case, it just got us out there. So that's short verticals. Let's look at some long options. By the way, yesterday in my long options webcast, I rolled Caterpillar. Okay? It was a nice little roll. We're losing money on this since the roll. We brought in, what did we bring in? It was a nice little roll we had on that. Let me just look real quick on that. Trade history. We rolled for like an $8,300 credit approximately on that, which was nice. And that's certainly not the norm, but it's nice to see those occasionally. But when you roll that, what it does is it resets it. Okay, so right now, it's, we're not off to a great start on this new version of the trade, because when you roll, basically what we're doing is we just got out of the old one, we're getting in a new one. The question is this. This is a Leaps call, okay, long-term trade. Are we still bullish on it? If we turn bear, which I would suspect since we just looked at it yesterday and it seemed okay, yeah, I'm going to consider that bullish still. We're not going to touch that trade. We got a long ways till expiration. It's a long trade. Okay, Alphabet. 58 days to go. Things are going pretty well. By the way, one of the reasons we rolled this Caterpillar, other than to bring in the credit, was to kind of lower that delta. That delta was like 87, 88 or something like that yesterday. This is around 73, 74 delta on Alphabet. And often we'll use on these long calls or long puts, when we get to those deltas that are elevated to the mid 80s or more, we may roll that. In this case, it's a little bit lower. This is actually one, I'm not going to take the time to show you right now, but we have actually rolled this in the past and brought in a credit on this one in the past. So we're going to stick with this. But, this seems to be doing fairly well. Since that roll, we're up a little money on this right now, which is great. But often if things are going great, it probably means our stop loss may need to be adjusted. So let's just double check our stop loss on this. A 1275 stop, okay, 1275 stop. The current price, and 1275 stop probably seemed appropriate when our initial trade was 18, 19 bucks. Well, the stock's now at 26 bucks. And so what I'm going to do is I'm going to put a 70% stop on that. So I'm going to take 7.7 times our current price, which is 26.45. I come up with about $18.50. I'm going to adjust that stop to $18.50. I'm just going to click on it. I'm going to right click. I'm going to cancel and replace that order. And instead of 1275, I'm going to move that stop up to 1850, confirm and send. We're automating that exit so we don't have to keep a constant eye on it. If it pulls back, I want to capture in. I moved the stop up to 1850. The now the stop doesn't guarantee we're going to get out at 1850, but if it did, then the loss we'd be at would be much smaller at that point, okay? Because we bought it for 1880, all right? So there's Alphabet. Let's move on down the list. Halliburton, up a little bit, still got a lot of time. I got a lot of leaps in this. I somehow just over time, hey, look, we tend to stay in leaps longer because they're intended to be longer term trades. Trade price, you can see the stock's gone up significantly, or the option has gone up significantly since we got in. Let's see what that stop says. Stop is, it doesn't tell us right here. It says it's a conditional order. What we can do is we can just pull up HAL, and this is a bullish trade. And let's go right here. Okay. So this is, our current exit is at 1975. That's down here. So here's our current exit. Stock's up there. Do you think we could move that stop up a little bit there? I would say so. We don't have to move it super tight. We could if we wanted to. We could go halfway up this big candle. We can go to the bottom of the big candle. We certainly hit some support down here. Certainly we can move it up at least to maybe 22 bucks, 22 and a half bucks. Well, let's do it. Let's adjust that to 22, up 22 and a half bucks. Okay. Let me click on this. I'm going to cancel and replace this order. And I'm going to click on the gear. We said 22 and a half bucks, just trying to, in case things go against us, which they certainly very well could, we're just trying to hopefully help protect our gains, even though it doesn't guarantee that it's going to do that. We're going to cancel and replace that order. Okay. Send. Okay. Now, okay. All right. So let's do this. Let me address the question in the chat from Jacob. Good question. Okay. I moved my stop on, what we say, Alphabet up to 70% was in my case of the current price. Why did I not move that up even higher? The reason is this, okay? I could try and protect it and say, oh, look, I want to move up to 70% of the gains we've already made, I think is what you're saying. Instead, 70% of the gains I've already made. Well, I've already made about roughly $8 on that, okay? So we could say, oh, I made $8, 70% of that, or that's be like $6, 75% of those gains. That would put my stop at like $2. That put my stop like at 24 bucks here in this case, which in my estimation is too tight, okay? Because if you look at an option price, I'll give you an example here. If you look at an option price, let me just copy this. Come on, doesn't it let me copy my symbol? Let me just do this. Okay, here's my option price. This is a price of the option. Normally I don't price out options, chart out options, but we got this. Just look in the last few days what this price has done. It's gone from 32 bucks down to 26 bucks. Okay, it's like a $6, it's like a 20% change in just a couple days on that option price. And similarly, you can see how the price has changed on this. It's moved up over time as well. Options are very volatile. So when I say I'm putting the stop in at 70% of the option price, the attempt is to not make it so that we get a couple bad days and it just kicks us out that quickly. Now, there's pros and cons of that. I fully admit that. We're potentially giving up bigger gains, even though stops aren't guaranteed, by doing that. But with the stock, we very well may put in a 10% stop on a stock price, on the underlying stock. On an option, that'd be, for most option traders, that's way too tight. So for option prices, usually I'm kind of in the 50 to 70% of the current price there. Now, could we have, in this case, said, look, we got in, our stop was, we moved our stop up to 1850. Could we kind of, let's say, move it up to 19 bucks, just to, if we were to get stopped out at that stop price exactly, which is a big if, but if we were to, then it would preserve the profit. You could do that. I don't have any objections to that there on that, but that's the rationale behind that. Hopefully that helps there, Jacob. Okay, let's move on, and because I'm running out of time here, and there are, I'm probably going to let's move to a different type of trade. I've done long options. Well, actually, let me do this. Let's look at Pfizer, because this is not a leap. We've been seeing some leaps there. Here we got a shorter period of time to go. So we're going to be less patient with this. We're basically break even, maybe a little bit north of that, but only 23 days to go. Are we still bullish on this trade is I think the question that we have on that. So let's look at Pfizer. Are we still bullish? It's not super bullish, but what I'd say is I've got a support level here, and as long as it's above that, that's okay. Of course, time decay is working against us. This is a long call, so I can go either way on this. I may wait a little bit longer. We've had a little bit more bullish momentum there. I think you can go either way on that one, no doubt. Let's go USB. Again, it's a call, not long till expiration. Are we bullish on this? If not, we're just going to look to get out. I'd say the trend on this one's a little bit better. I'm looking for a bounce here. I think we stick with that. Let's look at a couple more of a different variety of trade, perhaps. Let's go down here and let's go down to our calendars. Let's go to Comcast. What do we have? We've got a butterfly spread here on this. It's actually a skewed butterfly. We can look at this on our Analyze tab for a little help on this. CMCSA, and see what we got. There's our current price. Current price is right here. So we're actually in not a great position on this. We're down a little bit. The thing is, it can get a lot worse, but if it goes up, if it stays down here, it's probably not going to get that much worse, so that we can be kind of patient with it if we want. But you know, let's look at the chart. What's our feelings on the chart on Comcast? We want the stock to move up a little bit. It looks like it may be bouncing a little bit. I think we stick with that a little bit, because if it does go down, it's not a problem. Well, it could be a problem, but it's not likely. Looking at the Analyze graph, and the Analyze graph isn't perfect, but it looks like we're not in a bad situation if it goes down a little bit. So I'm going to be patient with that one. Let's do one more trade, and then we will call it a day. Let's go down. We did some back ratio spreads not long ago. Here's Uber. It's a call back ratio spread. I did this in my advanced options class last Friday. So this is a bullish trade. We're down some money on this. Is it time to cut bait? What I'd say is we still have a fair amount of time left on this. Am I still bullish on it? Okay, I have some exits in case it goes down a certain price, but let's just take a look and see, because it doesn't matter if we've hit our stop yet or not. If we're bearish on it, which I would say, use your technical analysis. I'd say, no, we had a little pullback, looking for the bounce. We'll let that stop, which is if it goes below $90, sit here on this. Otherwise, we'll keep an eye on that. If it goes below $90, it probably looks like we're breaking our trend on that. Okay? All right, everybody. Hey, thank you very much, everyone, for joining me today. I appreciate you. What did we talk about? We talked about automating setups when you're entering a trade. We gave some examples of a long call vertical and a long put vertical, and we automated setups based on both the stock price and based on the option price. Then we looked at a variety of other types of trades and talked about managing those trades as well. Just a reminder, I believe there is a survey link in the chat. And so if you would give us some feedback on that, we'd love you for that. I want to thank Ben for helping me out in the chat there. And coming up next, we've got trading price patterns. Barb teaches that class. Also, just a reminder, before this webcast, so think about this for next week, Ben teaches a trading index options class that you don't want to miss either. So make sure you check that out. Thanks for joining me, everybody. Have a great rest of the week. Bye-bye, everybody.